Buenos días, les habla Carles Gaju, gerente de distribución institucional de BICE Inversiones. Les doy la más cordial bienvenida a nuestro webinar BICE de hoy. Nos acompaña Sarah Wilson, Managing Director de Responsible Investing en Nuveen, Jessica Sariski, Portfolio Manager de Nuveen, y Emma Cohen, Vice President de Goldman Sachs Asset Management Fixed Income, quienes estarán a cargo de la exposición de hoy, Implementación de ESG en el proceso de inversión, importando prácticas internacionales, acerca de los principales aspectos del ESG Investing, sus desafíos y oportunidades. Tamara Palomo, jefa de inversión sostenible de BICE Administradora General de Fondos, moderará esta presentación. Durante la exposición, pueden ir escribiendo sus preguntas en el chat para ir respondiéndolas junto a los expositores. Al final de la presentación, les vamos a mostrar un código QR para que lo puedan escanear y nos ayuden a contestar una breve encuesta. Para nosotros es muy importante conocer sus opiniones y así ir mejorando nuestros webinars. Bienvenidos Sara, Emma y Jessica. Tamara, ahora te cedo la palabra. Muchas gracias.
Muchas gracias, Carles. Buenos días a quienes se están conectando. Les damos la bienvenida a este webinar Implementación de ESG en el proceso de inversión, importando prácticas internacionales. Tenemos a 3 profesionales expertas en la integración ESG en el proceso de inversión y ellas nos compartirán aspectos prácticos y aplicables, su visión, insights del proceso, desafíos y lecciones que han aprendido durante el transcurso. Las 3 invitadas que tenemos hoy son profesionales de área de Fixed Income. Sin embargo, el enfoque de integración en el proceso de inversión no es solo para esa clase de activos, sino que van a poder entregarnos algo de manera más transversal, así que todos están invitados a escuchar estas interesantes presentaciones. Antes de presentar a nuestra speaker, las 3 nos presentarán en inglés, so we're going to switch to English, and I want to say thank you to our speakers for joining us today. It's a pleasure to have you and our audience. Thank you for attending this webinar. For those who we will spend the next hour not learning why, but how to responsible investments or ESG integration. Now, without further ado, I'm pleased to introduce today to our first presenter, Sarah Wilson, Managing Director, Responsible Investment, Nuveen. Sarah is a member of the Responsible Investment team at Nuveen. Her responsibilities include the integration of environmental, social, and governance ESG factors in the investment process across asset classes, with a focus on fixed income. She also focused on measuring and tracking the social and environmental impact of the firm's public and private investments. So, Sarah, the floor is yours. Please.
Thank you, Tamara. I'm really happy to be here today, and I appreciate the opportunity to speak with everybody. Here at Nuveen, we are, let me make sure I can move this here. We are focused on responsible investing as one of our 3 main pillars as a firm. We use it to help clients achieve their goals and contribute to the world that we all share. We also focus on income and alternatives, but I think it's quite telling that responsible investing is a strategic focus of Nuveen, and we have a few areas where we believe that we excel in that focus. 100% of our firm's assets are committed to the UN Principles for Responsible Investment, and we have a large team that's focused on responsible investing. I manage a team focused on ESG integration, which means that we partner with our investment teams to help them integrate financially material, environmental, social, and governance factors into the investment process. We also designed the eligibility criteria for our over $37 billion in ESG-focused strategies. And later you'll hear from Jessica Zarzicki, one of our portfolio managers who runs one of those strategies. So I won't spend much time on why, because I know we want to get to the how, but we do believe that responsible investing is very important to helping us become better investors, to put it simply. We believe it helps us manage risk, generate alpha, and create opportunity. We also believe that ESG is essential to the investment process for our investment professionals across asset classes. And this has been true over the course of many decades. Our legacy in responsible investing goes back over 5 decades to the 1970s, when we began engaging with companies on topics like apartheid in South Africa. Fast forward to today, and we're making progress on ESG integration, but also on focusing on key themes like climate change, with commitments like net zero being made by our TIA general account, which is Nuveen's largest client. RI at Nuveen is different because we are focused around 4 areas: subject matter expertise, our centralized structure, market leadership, and our innovative capabilities. Our 30+ member RI team specializes in both public and private markets, and we partner with investment teams to help them integrate ESG factors that matter. This is really important because that means that ESG integration is not siloed into a separate team. We're not doing the work for the investment teams, but instead we are building their capacity to do the work themselves. We also believe that because we've been in the responsible investing space for a long time, we can help demonstrate market leadership and shape standards that help advance the practice of responsible investing across the entire market. And as you'll hear later, we've invested a lot of resources in innovative sources of responsible investing data to help our investment teams undertake ESG integration and also measure impact. So I'll quickly touch on the 3 principles that guide our responsible investing program, but I'm going to spend most of the time on our ESG integration work. So ESG integration, as you know, is incorporating material ESG factors into investment process using data, research, and tools. Now, this is different from ESG products, and I'll lay that out in more detail in a moment. We also engage very closely with companies in which we invest, as well as issuers of green, social, and sustainability bonds that Jessica will speak to in a moment. What that really means is using our influence to help make sure that companies are taking action on ESG topics and voting our values in a sense through our proxy voting and on shareholder resolutions. This is actually a key part of ESG integration. So the way that we vote as a shareholder and even engage as a bondholder is very important for how we consider ESG factors overall. And then finally, we're very focused on real-world impact. We measure, manage, and drive positive impact across asset classes, but especially within our impact investing strategies. I'm going to skip through this slide because it's very detailed and I want to get to other things. So I promised to talk about the difference between ESG integration and RI branded products. I think this is really important distinction. This is something that often trips up teams that are newer to this work. So on the left side, ESG integration covers all of our $1.2 trillion of assets under management. All portfolio managers and all research analysts are responsible for integrating material ESG factors into their decision-making. And the primary objective is to achieve competitive risk-adjusted returns. This is different from RI branded products, where in addition to delivering competitive risk-adjusted returns, there's a clear RI objective that an RI branded strategy or product is trying to achieve. RI branded products can make up somewhere around $42 billion of our AUM, and our RI product portfolio managers like Jessica are very, very focused on RI as that additional objective. The roles and responsibilities and reporting also differ between these 2 areas. On ESG integration, investment teams carry the primary responsibility for considering ESG factors. And my team is a capacity builder and an educator for those teams to achieve that goal. And then on the reporting front, the teams are looking at ESG characteristics of their portfolios, no matter whether they have an RI objective or not. So I'll show you an example or a screenshot of that in a moment. Now, on the RI branded product front, my team plays a much more direct role in helping design eligibility criteria for those strategies. And we also help with client-facing reporting. And I know Jessica will want to show an example of this, so I'll leave that for her. So getting right to it, what are some of the ESG factors that we believe are relevant or material across asset classes, including fixed income? Hopefully these look familiar. These should be sort of standard ESG factors that investment teams look at across the board. On the environmental front, things like natural resource usage like water, as well as climate change, waste management, and deforestation are all very relevant factors that can apply in different ways to different industries. For example, we believe that climate regulation can result in broad market shifts that affect valuation and affect, in some cases, consumer preferences and demand for things like fossil fuels. On the social side, employee relations, diversity, including gender and racial diversity, health and safety, and the supply chain management are all relevant factors, but especially for industries like retail or consumer packaged goods. Any company that has an employee base, which is pretty much every company, is going to be exposed to employee relations and diversity issues. And actually, we believe this is material in many cases. So for example, poor health and safety track record can lead to legal and financial liabilities for an issuer or a company. And then on the governance side, this is perhaps the bedrock of ESG. We find that many investment teams are quite experienced looking at governance issues when we begin working with them. But generally, this covers topics like executive compensation, business ethics, board quality, and board oversight. And we know that better managed companies with strong oversight tend to have better outcomes. So we've done a lot over the years, but I'm not going to dwell too much on that. I did want to focus on some of the ways that we measure success for integration. So I mentioned we are committed to the UN Principles for Responsible Investment. This is, as you know, for many of you who are signatories, a way to benchmark against peers who are similarly committed to the 6 principles under the UN PRI. And we're quite proud of our results. We typically receive A's and A+ on all of the modules under the UN PRI assessment. And last year, we were named to the UN PRI Leaders Group, one of only 4 US managers in that group, based on our climate risk reporting and leadership. I will say that UN PRI is a very useful way to essentially get a report card on your ESG integration work. We found that it's quite motivating for our investment teams over time to understand how well they're doing on the integration front through an objective measurement like the PRI process. So I'm going to get quickly to some of the how. On the integration side, our research analysts are assigning internal ESG ratings that cover all of their active coverage across different subsectors of fixed income. So we use a leader neutral laggard rating scale, and you can see the distribution of ratings here in the little pie chart on the upper left. And those ratings are assigned on the basis of training and a framework that my team has co-created with the Global Fixed Income Research Team. Right now, we cover over 1,300 actively covered corporate issuers, as well as 92 sovereign issuers, and at the structured security level, 35 different subsectors. These ratings capture our analysts' views on ESG performance of the issuer, where it is financially material to credit or pricing. And we propagate these ratings through platforms that our investment teams rely upon, like Bloomberg and FactSet, to allow for our portfolio managers to use them in investment decision-making. And this gives you a little bit of a flavor for the different investment cycle activities where ESG integration plays a part. So I mentioned analysts assigning internal ESG ratings. That's in the green research quadrant of the cycle here. Our PMs consider those ESG ratings as well as other data in security selection and portfolio construction. Our analysts update those ratings on an annual basis or as needed as new information comes to light. And our analysts work with our engagement team to meet with companies and discuss ESG topics on a regular basis. And then finally, our PMs are monitoring the ESG performance of all their strategies using a report that our team has designed and sends out on a quarterly basis called our RI Transparency Report. And that is sitting on the back of our responsible investing data platform. So I mentioned we've invested heavily in our resources, like our data platform, which aggregates third-party ESG ratings from MSCI, Sustainalytics, as well as other sources like Refinitiv and ISS to help our research teams understand ESG performance at the issuer level. And this information then flows into the portfolio level reporting that our PMs receive regularly. So what this tells our PMs is how is the ESG performance of the portfolio compared to its benchmark on things like the MSCI rating compared to benchmark, the carbon footprint compared to benchmark, as well as exposure to controversial business involvement areas like alcohol, tobacco, and gambling, and also how we voted on relevant proxy votes in the public equity space. So I know we're getting close to time. I'll pause here and perhaps pass it back to Tamara. I'm happy to take your questions at the end, but very, very excited to see progress on ESG integration in different asset classes and across different geographies. So very happy to speak to any questions that may come up.
Thank you very much, Sarah. I'm sure we have all enjoyed this excellent presentation. Certainly, it's a big challenge to ensure ESG integration at all levels of the investment process. And in particular, you mentioned the portfolio management stage and assigning a proprietary ESG rating using Bloomberg or different platforms that you mentioned. That really contributes and assists to assure the availability of data, and it is a practical recommendation that we can use to facilitate systematic integration in the investment decision making. And also you mentioned your transparency reporting tool, so thank you for sharing those recommendations. And now we are going to move to our next presenter. We already learned about a new BEAN approach to responsible investment in a broader and strategic view. And now we will move forward to another leading manager in sustainable investment strategies with a proved track record in ESG integration. I will present to our second speaker, Emma Cohen, Vice President, Goldman Sachs Asset Management Fixed Income. Emma is a member of the Fixed Income ESG research team in London and leads the efforts on social analysis and measuring impact in portfolios. Emma works with research analysts, portfolio managers, and traders across all fixed income teams to incorporate the assessment and analysis of social risk and opportunities in portfolio. So Emma is gonna present to us in a very concrete way ESG integration in the investment process and in the assessment stage. So Emma, thank you for being here, and I give you the floor.
Thanks, Tamara. Good morning, good afternoon, everyone. I'm really excited to be here with you today to discuss the topic of integrating ESG and fixed income. I have to say, following on Sarah's discussion, that it sounds like we're all kind of moving in the same direction, which is great to hear. So I might skip over some sections where we've already heard expertly from Sarah on their process and where ours looks quite similar. So as Tamara said, I work within our fixed income ESG research team at Goldman Sachs Asset Management. So if you don't mind going to the first slide. Great. So I'm mostly going to focus on the bottom-up process that we look at within our ESG research team, but I did think it would be helpful quickly to talk about the why for us at Goldman Sachs Asset Management Fixed Income. So first, and as Sarah said, we believe that integrating ESG into our investment process helps us make better decisions. So as bond investors, we're really focused on mitigating downside risk. So looking at investments through an ESG lens enhances that risk management process. Second, we do believe that ESG integration helps us to drive better issuer behavior in the world. So as a firm, we're focused on the two goals of advancing inclusive growth and accelerating the climate transition. In fixed income, we're aligned with these core objectives when it comes to encouraging positive issuer behavior. I'll talk more about this when we get to our bondholder engagement section. Finally, as an asset manager, we do understand the importance of partnering with our clients to achieve their sustainability goals through ESG integration. We really do understand that each client is on a different place in their sustainability journey. So we're really there to help and tailor to their needs. If you don't mind going to the next slide, Diana. Great, thank you. So this is quite a busy slide, but I think this is really the core of our process. So this is our materiality matrix, and it's the foundation of our ESG rating approach. So what this is basically is a simplified way of articulating what issues and themes are most material for a given sector. So you can see on the left-hand side that we have sectors, and across the top, we have pillars, themes, and issues. We use the same matrix across investment grade corporates, high yield, and emerging market corporates. The darker the shade on the map, the more material the issue is deemed to be for the sector. So I would say this is illustrative, so it's not exhaustive, but hopefully gives you a sense for things. Before I dive into some examples, I just want to point out two things. First, when we're deciding what's material for a sector, we really look to market standards. We're not trying to reinvent the wheel. So we really do look across market standards such as SASB and TCFD, amongst other well-established frameworks. Second, I just want to emphasize, and this sounds very similar to the Naveen process, that it's our fundamental philosophy that ESG belongs to the investment team. So not just those with ESG in their title. So why I focus on ESG research, much like at Nuveen, we're really upskilling our credit research analysts to do the work themselves. When we work through the process of building this materiality map, we actually worked very closely with the research analysts to leverage their sector expertise. One example that comes to mind is in the last couple of months, we worked with our financial research analysts to increase the weight of the E pillar for banks to reflect their view of the importance and the materiality of loan book carbon intensity going forward. So that just shows you how closely we work together and how their views impact this materiality matrix. So looking at the matrix, as I said, for banks, you can see the darker shading under the environmental pillar, but also quite a high weight placed on governance, really just reflecting the importance here of risk management and conduct risk at banks. Another example, if we look at energy, for example, is a high weight to environment, but also to governance. If we look more in the industrial space, some areas such as consumer non-cyclical, you can see that really here the focus is on social. And this can look in different ways dependent on the sector. If we're looking at pharma, for example, we're really looking to assess the product quality and safety of those businesses. The recent opioid litigation and the resulting fines does demonstrate the materiality of this theme for the pharma sector, just as an example. Next slide, please. So our analysts have really considered ESG issues for a number of years, but more recently we've provided a framework for which they can systematically apply an ESG rating to their coverage. So this sounds also quite similar to what they do at Nuveen, as Sarah explained, but really the rating process here is underpinned by that materiality matrix, which we just discussed. So analysts here are rating issuers on a scale of 0 to 5, with 0 being a laggard and 5 being a leader. And then to the extent possible, we've also invested heavily in data, and we look to leverage available data and metrics in this process. We do recognize, however, that a lot of ESG data is backward looking. So that's why we're really incorporating a momentum overlay to the rating. So analysts assess whether the company is improving, deteriorating, or stable on the environmental, social, and governance pillars. And then this has the ability to add or subtract from the ESG rating. And then finally, bondholder engagement is really core to our rating process. And I'm going to cover this in more depth a bit later. As a reminder, I've taken you through our materiality matrix with themes and issues, and then I've shown you how we apply these themes and issues in our ESG rating process for corporates. So next, I'm going to discuss how this works in practice with some case studies. Next slide, please. Yeah, perfect. So we're really fortunate. We've got an awesome tech team and data scientist team. We work with them daily, and they've built us this really nimble research platform, which we call Fluent. And it really captures all elements of the ESG process in one place, and it's alongside the fundamental credit views and opinions of the analysts. We can also track engagement side by side with these views, as you can see on the screenshot. So what you're looking at here is one of our analysts rating for a European automaker. So the issues in the weights listed here are applicable to the auto sector as a whole, and they're driven by that materiality matrix, which we just went through. So for this issue in particular, they had a significant environmental controversy a number of years ago. And this issue actually continues to drag on their third-party ESG ratings, because as we said, a lot of this is quite backward-looking. However, our analyst view differs from this narrative because of the company's performance on the environmental pillar. He actually believes that the company will be a leader in electric vehicles, And so he's reflected this in the leading rating on the E pillar. However, in the governance space, he still does have some concerns, and this is reflected in the rating and also leads to the fact that as a whole, the issuer is not a leader because of some of these concerns. And then on the social side, you can see we actually have signed quite a high weight at 40%. And here they're rated in line with peers by the analyst. So in my role at Goldman, I focus on social analysis and risk. And what I think is really interesting is the increasingly how connected the E and the S is together. So in the auto space, for example, this means really thinking about how moving from ICE technologies to electric vehicles will impact the workforce, and really ensuring that companies are actively managing this process to minimize downside risk and ensure key stakeholders are supported. Next slide, please. Great, thank you. So as I mentioned, our materiality matrix covers high yield, emerging markets, and investment grade. One challenge that we face with rating emerging market and high yield companies, and I'm sure others on this call face themselves, is data availability in those markets. So that's why when you have a sector materiality matrix, you can look to dig into the areas which are most material and use things such as engagement with the issuer as a tool for fact finding. So just to give you another case study, in this example, one of our research analysts engaged with the issuer, which is a Mexican cement company, 3 times in 2020, and these engagements actually drove their overarching ESG view of the issuer. So their view is that this company is likely to be an industry leader in carbon emissions reduction, and this view is actually underpinned by the fact that the issuer now has set both 2030 and 2050 carbon emission reduction targets. On social, the analyst has rated the company weaker than peers. On health and safety, this is primarily due to higher fatalities versus peers. That being said, they have signaled that the momentum is improving because looking at the trajectory versus the company's history, they actually are improving and committed to doing so. Overall, the analyst has rated the company better than peers. And this actually just led us to have conviction in an existing position and retain an overweight in the particular issuer in portfolios. Next slide, please. Great, thanks. So I'm mostly focusing on corporates today, but I did want to just comment that for sovereigns, we similarly have ESG ratings, and the process is quite similar. We also have a 0 to 5 scale, and economists can also capture forward-looking views on a country using the momentum factor, which can add or subtract from that score. It's actually really important to have that momentum view in sovereign ratings because data has a natural lag at the country level. So if we think about World Bank governance indicators, it can be more than 1 year delayed, the data you're seeing. So without this sort of momentum overlay, you can actually lose the pace at which a company is, as a country is improving. Next slide, please. Great. So earlier I mentioned that bondholder engagement is really a key part of our process. So to illustrate this, I just wanted to share another case study. So here we have a European utility, which has had issues in the past on water pollution and falsification of reported data. So ahead of a new bond issue, the analyst met with the company to discuss the past incidents and to better understand what steps had been taken since. Our analyst was encouraged by the changes that had been made at the company, including the appointment of new management team, but she ultimately remained cautious on the credit until she saw this translate into better performance. During our daily new issue call, our portfolio manager was looking to buy the name. The analyst shared her view of the company fundamentals and the ESG profile. The trader was then of the view that that risk was actually not priced in the market since the bonds traded at similar level versus peers. Ultimately, the portfolio manager decided not to buy the bonds, given we were not being compensated for ESG risks at hand. So I hope this kind of demonstrates the full circle of that process. We have engagements informing analyst views communicating to PMs and also being entered in our research system Fluent. Traders then think about how those risks are priced in the market and what opportunities are there to take advantage of potential growth areas. And ultimately, PM makes decisions with all that information. So to us, this is really what ESG integration looks like in practice. So if you just go to the next slide. So I know I've mentioned bondholder engagement a number of times, but I do want to harp on this because really 4 years ago, there was a view in the market that equity investors were the ones with a seat at the table through their stewardship activity and proxy voting. But I think that perception has really changed, and it's now recognized that bondholders have a voice and a seat at the table too. If we just think about the scale of fixed income markets and the fact that a majority of issuers come back to the market multiple times over a number of years, there's really an understanding amongst issuers that an ongoing dialogue with investors is both expected and it's actually key to accessing liquidity. So bondholder engagement can serve a number of purposes, but we really focus on 3 key areas of importance. The first, which we've been speaking about, is to inform our credit views and really focus there on material factors. The second is to influence outcomes. So just to give you an example, in my role as social lead, I'm currently working with other colleagues in equities to understand how we can use bondholder engagement to influence positive outcomes on human rights. This year, we also worked alongside equities on a collaborative climate engagement project to really influence better behavior on climate disclosure for top emitters. And then finally, engagement plays a really important role in influencing market structure. So we're constantly in discussion with issuers and syndicates to share our views on best practice with the goal of influencing how ESG labeled debt is structured. So if we go to the next slide, then I'm going to I think it's kind of an interesting area of the market to talk about. Obviously, we've been really focused today on sort of the bottom-up ESG research process, but I did want to highlight what we view as an opportunity, which is investing in ESG labeled debt. So a lot of people have probably heard these terms, but I'm going to just go over them quickly to make sure we're all on the same page. But when we say ESG labeled debt, we're really talking about 2 categories of instruments. The first category is project or activity-based bonds. These include green, social, and sustainability bonds. Sometimes you'll hear them referred to by their acronym GSS. So for GSS bonds, the proceeds from the financing must be spent on projects with environmental and or social benefits. So for example, for green bonds, issuers can only finance projects with clear environmental benefits. So an example of this would be, let's say a corporate issuer wanted to increase the energy efficiency of their buildings, or if a government wanted to electrify their public transport networks, they could use the proceeds from a green bond to do this. Social bonds, as the name implies, issuers can only finance projects or activities with clear social benefits. So an example would be if a bank was lending to SMEs in areas of high unemployment to generate jobs, or if a government used the financing from a social bond to increase funding for schools in economically vulnerable communities. And then finally, we have the category of sustainability bonds. These are really just a combination of green and social bonds. So issuers of sustainability bonds can finance projects with environmental and or social benefits. So that's the first category, the project-based or activity-based bonds. The second category here is target-based. So in the market, these are referred to as sustainability-linked bonds, or by the acronym SLBs. So while the proceeds of SLBs can be spent on anything an issuer wants, the issuer must commit to meeting certain ESG-related targets by a set date. If the target's not achieved, the investor gets paid a coupon step-up. So an example of this would be if a company issued, let's say, a 10-year bond, and they had a target of reducing carbon emissions by 2025 of a 30% reduction. If the issuer does not achieve that target by 2025, they agree to pay investors an additional 0.25% from 2025 until the bond matures, on top of the already agreed upon coupon. So really, in our role as an asset manager, we have to really review the quality of these ESG bonds because no 2 bonds are the same. To do this, we built an in-house evaluation process. Our assessment is focused on the content of the deal and the structure of the deal. Luckily, on the structure side, the market has matured somewhat. So now we see more than 90% of ESG bonds aligned to something known as ICMA principles. And that really helps investors spend their time evaluating the quality of the content as bulk of their evaluation. So our content evaluation then focuses on 2 key areas. The first is the alignment of the deal to the issuer's overarching sustainability strategy. And then the second is the ambition of the framework. So when we're talking about SLBs, we'll be looking at how ambitious those targets are. Are they really stretching beyond business as usual to hit those targets? And then for GSS bonds, we're looking at the anticipated projects that they intend to spend money on and thinking about the quality of those projects. And once again, are they stretching themselves in committing that financing? We're really seeing more and more clients looking to incorporate these types of bonds into their portfolios because it's really an opportunity in the fixed income space. And so we really do continue to support clients in this process. So we just go to the next slide. I'm not going to spend much time on this. I think Jessica is going to take you through Nuveen's process for portfolio construction, or at least talk about more the tools and the data which empower. But I did just want to highlight for us as well, thinking about how we then take all this information and build portfolios is really key. So for our portfolio managers, if they don't have a way to look at the risks of ESG across their portfolio and think about them in the construction process, then really all this works for nothing. So we've spent a lot of resources in building out our technology to do this in kind of a smarter and more innovative way. And with that, you can go to the next slide, but I'll just end there, and really enjoyed sort of giving you a background to how we think about the bottom-up research process, and looking forward to answering any questions in the Q&A. Thanks.
Thank you, Emma, for such an insightful presentation, very clear, for illustrating us with real cases, the analysis, assessment, and the engagement, and how the portfolio manager makes decisions with all that information and with the PM tools, and really touch on how responsible investment looks in practice. Thank you. I was heavily impressed to find several points in common with a proprietary ESG rating process at BICE. When you talk about the importance of momentum, given its proven relevance to generate alpha and uncover investment opportunities, that allows to have a more forward-looking view of the issue and not only backward-looking. So thank you, and to the audience, just as a reminder, please sure to type your questions into the chat box if you want to join our discussion. And for our last presentation, we're going to delve deeper into ESG, but now from a portfolio implementation point of view under different strategies. Our next presenter is Jessica Sarisky, portfolio manager at Nuveen. Jessica is a portfolio manager for Nuveen Global Fixed Income team. She's an integral part of the ESG Impact Fixed Income Strategy team and co-portfolio manager on the Core Impact Bond, Green Bond, and Short Duration Impact Bond strategies. Jessica's analyst responsibilities include sovereign and local markets throughout Western Europe. She's a frequent panelist and speaker at ESG and impact conferences and a member of the ICMA Advisory Board, which provides insight and guidance to the Executive Committee on issues affecting green, social, and sustainable bond markets. So thank you, Jessica, if you please.
Thank you, Tamara. And it's great to follow both Sarah and Emma and hear about the ESG and integration process. Obviously, I'm well versed in the ESG integration process at Nuveen, but Sarah laid out the groundwork, so it's great to follow on some of the comments that she made. Just really talking about ESG now and then, and integration versus impact. So now my slides are stuck. 1 second. Okay, there we go. Sarah had mentioned Nuveen has a very long history in ESG and impact. I'm not going to stay on this page for a long time, but just want to point out 2 or 3 things that will kind of help drive the conversation. Nuveen's been involved in this space since the 1990s, really focusing on the first launch of its dedicated ESG annuity strategy, which was 60% equities, 40% fixed income. As you can imagine, in the 90s, we were really focused on exclusionary screenings. We've come a really long way since then, but it's important to highlight where we started from in terms of this journey in this process. I also want to highlight on this page, in 2007, we created our impact framework. So we were definitely an early leader in the impact space. We still have the general guiding principles. These actually align very nicely with the ICMA guidelines. This isn't by coincidence. Steve Liberatore, who was really, and Amy O'Brien, who are really the architects behind Nuveen's impact and ESG framework, created this direct and measurable. Steve was actually on the XCOM committee that created the green bond principles. So we continue to use this direct and measurable approach that I'm going to talk about in a little bit, but we created this back in 2007 and continue to use it today. And then the last point on this page that I want to highlight, in 2012, we created our first dedicated responsible investing fixed income strategy. So next year, we will hit our 10-year anniversary for our core impact bond strategy. So we are able to tell our clients and tell the marketplace that you absolutely do not have to sacrifice returns when you're investing in a responsible investing fixed income product. And we believe that that is absolutely paramount when you're thinking about ESG and responsible investing, and that you need the financial returns as well as that positive outcome in both environmental and social. Just kind of putting it all together, how do you go from ESG integration into a branded strategy? So we've talked a lot about ESG integration and the importance of ESG integration. It is important. Our analysts are looking at ESG integration. They're looking at credit fundamentals and making sure that we are getting paid for the risks that you're taking when you're looking at an issuer, when you're looking at a credit. ESG integration is becoming ever more important. Sarah and the team are working overtime to make sure that the analysts have all the tools in place in terms of being able to help analyze a credit and making sure that we're at the forefront of what ESG integration looks like, as well as helping to drive some of those ESG ratings that Sarah was talking about earlier. When you start to move into the branded strategies, we really look at 3 types of branded strategies. One is a thematic investing. This tends to focus on carbon-free portfolios, portfolios around water. So there's a theme related to that. For our fixed income strategies that I'm talking about today, we move towards the right hand of the chart. We look at positive tilting. So what we're looking at is leaders in the ESG space. So we're taking that best in class approach and making sure that within our portfolio, we're actually not able to invest in companies that we would consider laggards. So we focus on the best in class companies, which I'm going to go into a little bit more in depth on the following page, and then also through that impact. You just heard Emma nicely explain what the green bond, social bond, and sustainability bonds are. So when we think about impact, we're thinking about use of proceeds at the CUSIP level or security level, and making sure that these projects are going towards positive environmental and social. So when we're creating constructing a portfolio, like the core impact bond strategy, we're using a combination of that positive tilting, best in class ESG and impact. So talking about a little bit about that ESG framework and ESG leadership. So the responsible investing team, Sarah does a tremendous amount of work around helping us create this eligible universe. And what's important to us is that this universe is transparent, it's repeatable, and that it has that tilting towards that positive environmental. So we're looking for those companies, when you're thinking about an ESG leader, and this is what you were hearing from both Sarah and Emma, is you're looking for companies that have a transition plan in place, that have metrics around meeting carbon emissions, reducing carbon emissions by 2030, by 2040, by 2050. What does that strategy look like? That would move an issuer towards that ESG leadership. Companies in the energy sector that are focused on that health and safety track record, companies that are leaders in that space, companies that have better track records around environmental. As you look at other sectors like banking, what do they have in terms of cybersecurity? What types of products are they looking at towards for their clients? All of these come into a nice holistic view of an ESG best in class issuer. We believe over the long term, when you focus on best in class ESG, you tend to help mitigate the risk of the portfolio on the downside, because these are management teams that are looking ahead, that are transitioning, that have strong governance metrics in place. So you help to mitigate the downside, but they're also can provide alpha over the longer term, because they are looking at new technologies, they are transitioning, and they tend to be leaders in this space. So we think that it's absolutely important to look at ESG best in class leaders. The other way that you're eligible in our portfolio is through our impact framework. I mentioned that we created this framework back in 2007. We actually have created these 4 themes in 2007, 2 related around social outcomes, which would really nicely links to the social bonds, affordable housing, and community and economic development. So when we think about affordable housing, we're looking to fund housing for low and moderate income families. We're looking at how can communities benefit from that? So, and we're not just looking at affordable housing opportunities in the US, we have opportunities across the globe. And you'll start to see that when I talk a little bit about our impact reporting. So we've invested in affordable housing projects in India, where you can have a tremendous amount of impact in this space. When you start to think about community and economic development projects, I think last year, And in 2020 and 2021, we've seen a significant amount of focus around community and economic development. Some of that relates to, COVID and coming out of COVID, and really focusing on essential healthcare, supporting the SME businesses, making sure that there's job security in this space. So an example of a project that we've invested in terms of community development is we've invested in the Women's Livelihood Bond, which really focuses on communities in Southeast Asia, in countries like Cambodia, in Indonesia, and in India. And this is really supporting women's businesses and making sure that they're taking a leadership role, whether it's providing a loan so that they can actually take their product and for a loan for a car, so they can actually take their product into the towns and sell it, whether it's around sustainable garment making. These are very powerful projects and can not just impact the individual woman, but can actually have an impact on generations. We've invested in projects in Latin America in the community and economic development. In Brazil, access to clean sanitation. Again, that affordable housing element comes in terms of access to clean water. All of this can have a huge impact on an individual and have really change the life, and that's what's important for us. When you think about social, oftentimes social can be much more acute because somebody feels it on a day-to-day basis. So when you're able to provide that person an affordable housing or a break in order to lower costs in terms of transit, it can make a huge difference in an individual's life. And then just turning to the environmental side, we focus on renewable energy and climate change. There's a great project in a Chilean pulp and paper company where they're actually taking waste to energy. So they're taking the waste of the timber and able to form a renewable energy product. And they're actually able to power the entire mill through this renewable energy source and then sell additional energy onto the grid. And so we're looking to invest in projects like that where you have that direct use of proceeds and the CapEx is going. Also for that pulp and paper company, they're not just focused on that renewable energy. That was the largest component of that particular project, but there's also that focus on biodiversity and conservation, which takes me to our last category on natural resources, where you're focusing on forestry, conservation, making sure you're stopping deforestation, agriculture, which is becoming much more important, and we're seeing more opportunities in the use of proceeds in the green bond space that's focused on agriculture. We were one of the first investors in the sovereign Seychelles sovereign blue bond that was focusing on conservation in the water and what that looks like, sustainable fishing. So these all have very positive outcomes that are important to help drive capital and meet the goals that have been set by the UN SDGs, by the Paris Agreement, by COP26, and the importance around that. This really talks to Nuveen's engagements on the fixed income side in impact. So we are a leader in the space. We have a long history in impact investing. And so the timeline shows some of the inaugural investments that we've invested in, talking about the Seychelles bond, talking about the first forest bond, again, that conservation effort, the first COVID relief bond that was issued by the IFC. We believe that engagement is absolutely important. We did 84 engagements last year with issuers. We're actually in 2021, we're well above 155. And this is talking to issuers about both ESG data information that they should be, additional data that they should be providing, disclosures, but also through the structure of green, social, and sustainable bonds. And we think that that's important. We tend to be one of the first calls if an issuer has a more unique, more bespoke type structure, or if a new sector is coming to the marketplace. So we're able to help the issuer structure the type of bond that we're looking for, make sure that we're getting the data that we need. And I'll talk a little bit about the measurability when we get to the reporting sector and section and why that's so important at Nuveen and for our clients. maybe just taking a step back, I've talked about the use of proceeds and the goals. When you think about the amount of capital that is needed to reach the UN SDGs, to reach 1.5 degrees, 2 degrees, you're talking about trillions of dollars that needs to be invested. So when you're thinking UN SDG goals, you need $5 to $7 trillion per year to meet these 17 goals. That's a tremendous amount of capital. We believe that the fixed income market is one of the best ways to use capital to direct it towards these projects. Because of the use of proceeds, we're able to see the types of projects, the underlying projects, and we get that measurability on an annual basis. So we have that check to make sure if a company has a 2030, 2050 goal, that they're actually meeting it, because we can see the underlying capital projects that they're putting to work through the green, social, and sustainable bonds. Just quickly, I'm not going to spend a lot of time on this slide, but this is really an overview of the sustainable bond markets. We've seen tremendous growth in this space. When you're thinking about the labeled bond markets, it now accounts for about 5.5% of the overall fixed income markets, and continues to see growth. We hit the 1.3 trillion in 2020, and 2021 is on pace to be another record year for issuance. We're probably likely to be north of about 850 billion in that GSS, that green, social, and sustainable bond space. What we are seeing is more diversification, and I think that's really important in this space. As you see the evolution with the first green bond really being launched in 2007 to where we are today, initially you were looking at very high quality, supranational World Bank papers, but the evolution has been great to see. So now we're seeing sector diversification, not just utility sectors that have that renewable energy, wind and solar project, but you're seeing consumer products come into the space. You're seeing more sovereigns issue green or sustainability bonds or SDG bonds. And it's a very powerful tool. And as we continue to see diversification, that means when we're looking at the construction of our core impact bond strategy, that we can absolutely increase the amount that we have in terms of impact exposures. So just talking a little bit, I've talked a lot about what we consider impact bonds, the green, social, and sustainable, that's direct use of proceeds, where you have that direct and measurable outcome. What we've seen in terms of sustainably linked bonds, they tend not to work for us and meet our impact framework. And so there's a couple of reasons. They're not use of proceeds based. While we applaud any company or issuer that is setting top level targets, what we found in terms of sustainably linked bonds is they tend to be unambitious at the start. So you tend to get more of a headline than the actual ambition that we're really looking for in this space. And when I think about that, the structure is unique in terms of, I'll give an example because I think that's probably the most powerful way to explain this. So if I look at a consumer food company, there was one that issued a green bond, and this particular company focused on sustainable agriculture. It was focusing on making sure the supply chain and the suppliers had the sustainable agriculture. They looked at training for farmers. They looked at how to make water more efficient, recycled water, big recycled water projects, stopping deforestation. And then they are able to provide us measurements on the backside of the number of farmers trained, the number of the amount of water saved, and also increase in terms of overall crop yield because of the metrics that they were taking in place, and then the conservation around stopping deforestation. That's a very powerful tool, and that's very powerful to share with our clients. Another company in the same sector, in the same industry, another consumer food company issued a sustainably linked bond. And so the headline becomes, we're going to reduce our greenhouse gases by 25% by 2025. through scope 1 and scope 2 emissions. And so when you start to kind of dig into the details in this space, you start to see when you're only focusing on scope 1 and scope 2, that only accounts for 5% of that company's overall emissions. So they're actually not fixing their largest issue, which is actually in scope 3 and relates to sustainable farming, agriculture. And so when you're not getting those projects in place, why it's a great headline to see that you're reducing your greenhouse gases by 25% in 5 years, you're actually not tackling the main problem that the company faces in terms of its overall emissions. So we found that most of the sustainably linked bonds that we've looked at tend to have an eye-popping reduction number, but when you start to dig into the details, either the company's already met their targets or close to meeting their targets, and the ambition's not there. And when you have ambition, that usually means that you have projects behind it and that you can come with a green, social, or sustainable bond, because you need that CapEx to truly meet that ambitious target of those goals. So just talking a little bit about reporting, I will say Sarah and team do a tremendous amount of work on this reporting on an annual basis, but we think that this is so powerful. And this goes back to that measurement component. It links nicely to our 4 themes. It aligns with the UN SDGs, but it shows our clients the impact that they're making when they're investing in our portfolios. So looking at the number of affordable housings, 2.8 million, that's actually more housing units in the entire country of Norway. When you're thinking about CO2 equivalent emissions avoided, 355.7 million metric tons, a lot, a little, but when you look at the equivalent, it's equivalent to the emissions of 90 coal-fired power plants, from 90 coal-fired power plants. It's very powerful and it's very tangible. And so this is what we're driving for our clients. This is the change that we're trying to make when you're investing in our portfolios, and you do it without sacrificing performance. And we think that that's absolutely critical. This has been an evolution. I'm sure Sarah could talk about the evolution better than I can, but they've put a tremendous amount of work in this. So, this is the nice one-page snapshot, but then we start to break it down geographically. So we've invested 211 million in projects in Latin America and looking at projects globally. You can start to see, again, a more detailed breakdown of the geographical metrics, talking a little bit more on the US and the power there. Again, breaking it down and what we've invested in the Americas, and 6 countries across the Americas. This year, we'll actually have our largest investment in Africa. So we're starting to see change. We're starting to see more emerging markets come in, and we think that that's great because you tend to have a much higher impact when you're thinking about emerging markets. And so with my last slide that I'll just talk about today is just on our overall ESG and impact fixed income strategies. I talked a lot about the core impact bond, which is our flagship strategy, which is going to hit the 10-year track record. But we also have the short duration and global, and these are benchmarked against your traditional benchmarks. So these 3 strategies use the combination of that best-in-class ESG and that impact element. And then the final 2, the green bond and social bonds, are 100% impact. So there's a lot of variety out there. But there's also a lot of great options. But the key takeaway is you can absolutely make a impact by investing in fixed income, and you shouldn't be sacrificing performance.
Great, Jessica. Thank you so much. Great presentation. Thank you for sharing details and the real case of the company in the agriculture sector. It's very useful to share those kind of cases to our audience today. Certainly, Nuveen has a lot of history on impact investments, a lot of goals met, and in terms of positive impact, that should be very rewarding. So we have covered a lot of ground. Now we will move quickly to our Q&A session. It's going to be 1 or 2 question tops for each presenter due to time constraints. I will go on the same order as the presentation. So the first one goes for Sarah from Nuveen. Sarah, when it comes to client reporting on ESG for all kind of products, responsible investment, branded, and the ones that integrate ESG, what indicators do you report to demonstrate that right objectives are met?
Thanks, Tamara. So for our ESG and impact funds, I think Jessica did a nice job laying out some of our impact reporting. We also report on ESG quality compared to the benchmark, and we tend to use our third-party ESG ratings for that purpose. So we primarily focus on MSCI, but we also have access to Sustainalytics and can report on either basis. And what that really tells you is on overall ESG performance, how is a portfolio looking compared to its performance benchmark? And I'll note that all of our ESG and impact funds they're not benchmarked to ESG niche benchmarks. They're benchmarked to standard mainstream benchmarks. And that's partially to help prove out the thesis that Jessica ended on, that you don't have to sacrifice performance when selecting an ESG or an impact strategy. So you can compare performance on an apples to apples basis with a mainstream benchmark. And then you can also compare ESG performance and impact outcomes to that benchmark as well. I will say it's more challenging to do impact reporting compared to a benchmark because the benchmark tends not to have exposure to some of those green, social, and sustainability bonds that Jessica really focused on. So we're typically reporting out absolute impact for impact investing strategies. But over time, we do hope to have that comparative reporting as well. For non-ESG strategies, we are also able to produce ESG reporting for clients upon request. This looks somewhat similar to the ESG quality reporting that we would do for an ESG strategy. We're looking at ESG ratings compared to benchmark. We're looking at things like carbon footprint compared to benchmark and exposure to controversial business areas if the client is interested in that. That is, as I mentioned in my talk at the beginning, all of those things are monitored by our PMs on a regular basis internally, and increasingly we're getting interest and demand from clients to see those metrics externally as well.
Thank you. So that's very useful and clarifying. I'm taking personal notes. So next question is for Emma from Goldman. Emma, how can clients approach integrating climate goals into fixed income portfolios?
Thanks. Actually, that's a great question. It's something we're focusing a lot of time and energy on. So I think what we've seen is really sophistication in client demands around climate portfolios change over time. So for example, if we think back a couple of years ago, I think there was a focus on how do we just decarbonize the portfolio today? And what that ends up doing is actually tilting away from carbon intensive sectors such as energy, cement, et cetera. But I think what we're moving towards, which we're really happy about, at least within our business, is looking at net zero solutions. So what that means to us is really looking at a portfolio today, focusing on which sectors do we view to be high impact or high carbon, and then looking through those companies and looking if they have credible strategies to decarbonize in the near term, and also looking at their long-term goals. And if those aren't in place, then it's about taking action through engagement and actually having a sort of an escalation ladder in terms of how we'll approach the situation if over time those goals aren't met, or if they aren't setting those goals in an ambitious way. So we think we're really moving from this tilting out of industries into trying to stay invested and have a voice in the table, as we said, through bondholder engagement, and really look to do that in a systematic way in portfolios.
Thank you, Emma. I really appreciate your details that you share in this matter. Let's move to another question. Jessica, the question for you, during the presentation, we saw that impact portfolios are present in America ex-US, among several other regions. How do you see Latin America for this type of investments? And we will appreciate hearing from maybe a specific case that you remember.
Sure, that's a great question. We're actually really excited about the developments that we're seeing in Latin America. I would say Chile, the actual sovereign, has been a leader in terms of impact issuance. They've done both green, social, as in hard currency, as well as local currency bonds. So there really has been a shift in terms of projects and making sure projects are going towards positive environmental and social outcomes. What we've seen over the past year is a little bit of a shift in the types of issuers that we're seeing from Latin America. The pulp and paper companies that I mentioned earlier were really at the forefront in terms of green issuance in Latin America. There were two Chilean pulp and paper companies as well as Brazilian companies that came to the market very early on. That was also followed by some utility companies in Latin America. But now what we're seeing is we're actually seeing more banks getting involved in this space. And banks are really interesting because they have insight into their lending book and they can drive lending towards these types of projects. Obviously, if it makes sense from a return basis for them and a risk basis, but we're starting to see banks get more involved across Latin America. So we've done a number of engagements with banks in Chile, in Peru, as well as Brazil, and what that looks like in terms of coming to this market in green, social, and sustainable format. So across the board in terms of impact investment. So I'm excited at the projects that we're seeing from this space, and we expect to continue to see more.
Perfect. Thank you, Jessica. We have, yes, we have seen great progress in the bank industry and in Chile too. Thank you for answering. We're running out of time, so a quick, very brief last question for Sarah. Sarah, what would you say are the main difficulties that you may find in constructing a new ESG integration program, assuming fund investment and security investments?
Yeah, so I would say the biggest challenge initially tends to be helping our analysts and portfolio managers first understand what we really mean by ESG integration. There tends to be an assumption that when we talk about ESG integration, we're actually talking about what Jessica does, which is impact investing or investing in ESG leaders. And there's an assumption that we're trying to exclude sectors or companies from their investable universe, or only focus on positive impact. And so it's an education process to turn back and say, no, actually, we're focused on how ESG factors can have material financial impacts on the valuation of a company or the credit quality of a company, to focus on the corporate asset classes. And then I would say there's also a learning curve and perhaps resource requirement for investing in data. So it took several years for us to get all of the external ESG data inputs that we need for analysts and PMs to have the information they need at their fingertips, and then familiarizing the teams with how to interpret and use that data, because there's a very wide variety of different ESG data out there. You can buy what I'll call raw data from that captures company performance on things like water usage or carbon. You can buy packaged ESG ratings from MSCI and Sustainalytics, and you can buy all kinds of specialty indicators on things like the Sustainable Development Goals or climate change. So there's a lot of investment that we made, and that I think most investors have to make at the beginning to acquire that data and then learn how to use it.
Perfect. Thank you, Sarah. That's very interesting. So I will say that all the questions were answered. Finally, I would like to thank your three presenters today for taking the time to share leading practices for ESG integration in the investment process. I know that what drives you here is not only commitment to your company, but the aim, the personal aim of promoting sustainable investing within the asset management industry. So that's for now, and I leave you with Carles for closing remarks.
Muchas gracias, Tamara, and thank you very much, Sarah, Emma, Jessica. Again, muchas gracias a todos los que participaron, y en nombre de BICE también les quiero pedir si antes de que se vayan, en pantalla pueden ver un código QR. Les pido por favor si pueden escanearlo y nos ayuden respondiendo una breve encuesta. Para nosotros es muy importante conocer la opinión de todos, ya que nos ayudará también a seguir mejorando en los próximos webinars. Esperamos verlos pronto y que estén muy bien. Muchas gracias a todos.